Hi there, Nicholas Campion here from First Formations, and welcome to another episode of Whiteboard Thursday, where we provide advice on a wide range of business and company matters. If you find this video useful and you enjoy it, please give us a like and share it with your friends and colleagues. But for now, let's get started. Today we're going to discuss the pros and the cons of share capital. The size and shape of share capital varies between companies depending on their funding requirements, stage of business development, policy of the company owners, and a multitude of other factors. But first, for those new to company matters, let's consider what we mean by share capital. Now, a limited company must assign a nominal value to each of its shares upon incorporation, for example, £1. This nominal value, also known as par value, represents the limit of the shareholders' liability. It denotes the sum that they must pay for each share that they own should they be requested to or the company is wound up. The share capital of a company refers to the total nominal value of all shares which have been issued by a company. You'll sometimes see this referred to as the aggregate nominal capital. So for example, if you have a company and it's got 100 shares, each worth £1 each, well, then that means the total share capital of the company is £100. The value of the company cannot be determined by reference to the share capital. Instead, it is necessary to consider the market value of each share, which will generally be higher than the nominal value. The difference between the nominal value and the market value is known as the share premium. In the context of this video and what we're talking about here today, we're discussing the merits of living with a large share capital, either from the point of incorporation or later by choosing to utilize share capital as a means to develop a business rather than using other vehicles such as business loans and so forth. So without further ado, let's dive into the heart of the issue, the pros and the cons of share capital, starting with pros. There are occasions where it may be necessary to demonstrate a certain level of share capital. For example, some lenders and creditors might assess the creditworthiness of a company by taking into consideration the size of its share capital. Also, certain trade organizations sometimes apply membership requirements of a minimum size for the share capital. A larger share capital can have the effect of making a company appear more financially secure. Investors may be more inclined to back a business with a large share capital. However, appearances can be deceptive, so increasing a company's share capital will not necessarily make it a safer bet in the eyes of experienced investors. Some companies will decide to increase their share capital as an alternative to taking out a loan, the advantage being that there are no interest payments here. Although dividends are often paid to shareholders, this depends on the success of the business, and there is generally no obligation to pay dividends. Furthermore, there are no stipulations attached to capital raised from shares, whereas a bank loan can come with various restrictions. For example, it might only be able to be used for a specified purpose agreed in advance. Overall, using share capital instead of taking out a business loan can offer a company more financial flexibility. Now let's consider the disadvantages of share capital. Increasing a company's share capital can lead to the shares of existing shareholders becoming diluted, and this can affect both the dividend payouts and the voting rights. Although an ordinary resolution is required to allot new shares, that is, the majority of those shareholders will need to approve an increase in share capital, this can leave a minority of shareholders discontent with the change in circumstances, and it can cause problems in the future. In general terms, increasing the share capital through the allotment of new shares will reduce the level of control of the founders, as the more shares that are created usually means the more power that is given away. If there are multiple principal shareholders and the new significant shareholder buys up enough newly created shares, they may be able to form an alliance with an existing principal shareholder, changing the balance of power. And at the extreme end of the scale, a company which issues too many new shares may be vulnerable to takeover by a competitor. Even if there is no need to allot new shares, a larger share capital may create more risk for the existing shareholders. For example, if the nominal value of each share is set to £1,000 instead of £1, then the shareholder's liability to the company's debts is equal to £1,000 for every share owned, as opposed to £1. This may look good to outside investors because it demonstrates that shareholders have invested a substantial amount of their own money in the future of the success of the business. However, if the company runs into financial difficulty and gets wound up, each shareholder will lose more of their own money. Now that we have walked you through the pros and the cons of share capital, just how do you go about increasing and decreasing it? Well, first of all, let's take a look at how to increase a company's share capital. It'll generally be necessary to issue new shares, known as an ordinary allotment of shares. The basic procedure would normally require the existing shareholders to pass a special resolution, consenting to the issuance and waiving their right to preemption on those new shares. This requires a majority of 75% or more of the votes cast in favour of the resolution, either at a general meeting or via written resolution. The company and its directors are then usually allowed to issue those new shares. However, these procedures may differ from company to company. And within 1 month of the allotment of shares, the form SH01 needs to be submitted to Companies House to notify them of the procedure having taken place. This form includes a statement of capital, which must be filled out to reflect the company's issued capital following that allotment. And finally, the register of members needs to be updated and new share certificates should be issued within 2 months. Now, let's look at how to reduce share capital. There are many different reasons for decreasing the share capital, but the overall effect will be to transfer capital from the company back to its shareholders. It is worth remembering that there are strict rules on this matter, so if you're unsure about them, then you should seek professional advice. In general terms, a reduction in share capital is usually achieved by a special resolution supported by a solvency statement of the directors. And within 15 days of the passing of the resolution, Form SH19 needs to be submitted to Companies House together with a copy of the said special resolution, a director's statement of solvency, and a director's statement of compliance. And remember, a reduction of capital carried out in this way is only effective when Companies House process that SH19 form. And there you have it. Today we have provided an introduction to share capital, the pros and cons of share capital, as well as using it as a means of developing your business, and also how the procedures of how to increase it and decrease it are undertaken. If you have any questions, please leave them in the comments section below. And in the meantime, be sure to subscribe to our channel to get more advice on limited companies, reporting requirements, and tax obligations. We're always happy to hear from you, and we can't wait to help. Until next time, cheerio.